Welcome to Markets Now. I'm Michelle Rook with John Payne with Hedge Point Global Markets, and seeing mixed closes on Monday in both corn and livestock futures trade. But let's kind of pick this apart, John. First of all, soybeans, a nice run back above the $12 mark here. Was that end of month and quarter short covering, or did we get pulled up by the products, especially the oil market?
I think the products are my kind of go-to at this point. When you look at the oil markets and how they corrected 2 weeks ago, I think it was very similar to how we saw the bean markets fall. In the case of the last couple of days, week and a half, we've seen the edible oil markets across the globe rally. Palm oil, canola oil, and then the rapeseed in Europe. All of them have been on the come, and I think that's good for soybeans and soybean oil in general. Bean oil has a lot going for it here, but price parity isn't one of them. So when those edible oil markets get cheaper, bean oil is going to struggle on the margins. But we've seen them get back more competitive again. I think palm oil might be trading at recent highs. So there are some things here I think that you could really sink your teeth into to be bullish beans. But we probably need some help from the USDA on Friday. Ideally both from the grain stocks and from the acreage report.
Absolutely, and we can talk about that in a moment. As far as the corn market today, did not follow soybeans, but did that market just run up into some chart resistance? Because we've been pretty range bound, haven't we?
Yeah, corn's been a bore, and I look for it to be that way. Once we get through these numbers here, there really isn't a whole lot, in my opinion, of deciding factors. I mean, the Brazilian crop is what it is. You could make the case it's awful, and some folks are, but Brazil or Argentina is great. So Argentina can pick up where Brazil leaves off to a degree. They're going to have roughly the same amount supply year over year. And then the Ukraine, I think the Ukrainian war would be one wild card that, obviously that's been a wild card for a while, but I don't think you see it priced in as much as it was. And, I'm not a military expert by any degree of what's going on in the Black Sea, but, if Russia would try to do anything and break towards the center of the country, and I'm not saying they can or they will, but that would be something that isn't priced in. And that's where you could get that market moving because, Michelle, that's where that excess supply is coming from now, not Brazil like it was last year. It's going to be the Ukraine this year because Ukraine has kind of ironed out a lot of its supply issues and it's got new logistics with grain moving into Western Europe. So I think at this point, that's the big wild card for me outside of U.S. weather.
Yeah. So do you think that the wheat market has been putting in a little bit of war premium, John, with what's been going on over there?
Yeah, I think so. I think we saw the tenders last week. The Russians are no longer the cheapest offer. And so you have kind of a weird dynamic where they have these export taxes up that keep the price, we'll call it $230, $235 a metric ton. They've been above that for the longest time. Pre-war it wasn't, but post-war we were. And so now we're falling below that price. And so the Russians are either going to have to lower the export taxes, which, is a budget thing, I imagine, and the farmers probably getting some payout from having them where they are. Maybe they'll raise the export quota, but regardless, the Russians, aren't going to move supply if they're not the cheapest in the world. This isn't charity. A lot of the folks in North African regions will buy, excess Black Sea, or they'll buy their traditional partners in France. And as of last week, France got cheaper than that price point. So I think we found our kind of water level here in wheat. I do look for some premium to be put on or possibility of it. You look at KC July volatility, it's like 32%. And I don't know, that probably doesn't mean a lot to people, but like corn trades at like 20%. And so you're just seeing huge swings priced in the market. And given where wheat trades, I don't know if you could convince me it can't go up. It's just because it's been going down forever. It seems like it can't, but I would be shocked to see a quick run to 650 on that July KC and make some of these producers here think about, pricing ahead.
Yeah, we did have a higher weekly close though in all the wheat contracts or wheat classes last week. And so that's why I asked you if you thought we were putting a little risk premium in. Of course, we are going into end of month, end of quarter. We've got big reports coming up here on Thursday. And so what do you expect going into the reports? What's already priced in, John?
Well, I think the volatility of it is priced in. And so if it's a bearish report on corn, I wouldn't chase it. And if it's a bullish report on corn, I think it's an opportunity to sell as a producer. If you're an end user, I certainly wouldn't chase. The market will react. The farmer will react. The one thing now that going forward, and you look at market like wheat, we'll get crop progress reports now. So we'll have kind of something more, a little more juice to sink the teeth into as far as the trade goes. If the idea would be that the U.S. wheat crop doesn't look good, I think the price again could go to that 650 price level for July KC. But beyond that, I think we need to see some real issues develop globally. And right now, that's not the case.
Yeah. Do you feel like we have like 91, 92 million acres of corn already priced in? And so if we get like 93 and above, that would be bearish? Or what do you think is the market already trading?
So I came in this business in 2007, so I've gotten to see a little bit. I'm not trying to see I've seen everything, but that's a lot of quarterly reports and WASDE reports. In my lessons, I've got diaries, kind of try to keep notes on this. The quarterly numbers are where the surprises tend to come from. And a lot of times it's not in the acreage, it's in the grain stocks. So there's other things that can move the market outside of just what we all, it's easy to guess on a yield number. I'm sorry, an acreage number, just because it's easy. But in the case of the grain stocks, that's a little more harder accounting, and we could see some surprises there. So I personally look for 93 million. I just think the USDA tends to shade corn a little bit. I think I'd be prepared for corn to be high. If that was me, I'm wrong a lot. So take that for what it's worth. But if you're going to be wrong, especially as somebody who's producing the crop, I think you'll get short dated new crop options and try to spread it off your crop insurance a little bit. And I think there's some opportunities there to try to get some risk covered through what will be a volatile time of the year. And it always is, Michelle, between now and the 4th of July, you and I will have, if we talk every week, we would have volatile conversations every week.
No doubt. And you mentioned quarterly stocks. And of course, 2020 is a really good example of where quarterly stocks were a huge mover for 2 quarters in a row. What do you think about the cotton market? What's the cotton market looking for? What are you looking for in either quarterly stocks or the acreage report that might move it?
All right, so this will be just acreage for cotton. The WASDE has really been friendly cotton because it gets to highlight that old crop carryover, which I think is sub 2 million bales now. But for new crop, the kind of consensus, I think, and I'm not trying to call myself some sort of out-of-the-box thinker, I think the consensus is thinking higher bean acres, lower corn. Because of the corn price, we'll see cotton catch some corn acres as well. So, you'll see closer to 12 million, 11.5 million, 12 million acre corn cotton crop, rather, which takes us above the 2 million, 2.5 million bale carryover, which has been supportive for the history of the trade, at least over the last 15 years. So that's, I think, where, December and May and July are 2 different markets right now. So if you want to play cotton and you want to do it, aggressively, look in the old crop markets, because that's where the fireworks could happen. I think here in new crop, until it gets in the ground and we start to see some issues, I don't think cotton's got much to move one way or the other, because I think it'll lose acres if it falls too far.
Yeah. And funds, boy, they really piled in and bought the old crop for sure.
Yeah.
Okay. Cattle market, bearish cattle on feed report. Yeah. We worked it into the trade today with triple digit losses. Do you think there's more downside potential though?
I don't. I'm not in the short run anyway. I'm just kind of playing these 2 stories. If you're bullish, I look at it this way. I would say it's, the markets, we're still in Lent. We haven't come out of the prime meat demand time of the year. So, do we need to see a huge correction here? And then you have packing margins that have kind of started to trickle into the green. And I don't think those guys are going to let that get away too far, because if they don't, I think you'll see the beef price go up, and then one of them will. So it's kind of a prisoner's dilemma game to a degree, where one of them cheats, gets ahead of them, and then it can affect their profit margins. So I think in the short run, we'll see some volatility downside, but I'd be careful. We were down 3 to 4 days before the report in feeders specifically. So, I don't know if there's a whole lot of downside, but we're $250 contract now. 10% is $25. I mean, that cannot be, you can't put it to yourself to be able to predict a 10% move in commodities. It's just too difficult. And if you can't handle a $25 move down, you probably shouldn't be margined up. You need to be protected. And I think, the time, unfortunately, is kind of past for that. So I would be, maybe skewing bear spreading the front. You think selling feeders up front, buying feeders in the back, and then vice versa in the live, given that the margins could stay strong here in the short run.
And we did have record cash trade last week in the Fed market, so don't forget that. And the hog market, just quick there, did you see was it cattle hog spread unwinding here today? Because I thought maybe the funds were done buying in that hog market.
Well, the hogs this is their Super Bowl. We only have 4 reports a year in hogs, and we'll get one of them on Thursday as well.
It's report positioning, huh?
I know. I think so. I mean, I think it's a place to go put a bet on to a degree. I know if you have, the ability to trade like exotic positions, you can try to get like a shorter dated hog position put on here under the summer, maybe protect yourself a little bit if these inventories would be high. I would look at the back of the curve, but I've been saying that for $2 or $3 now. And now we're kind of into the margin levels that producers might find a little more attractive. That's where it gets hard because the futures are expensive in the front and they're cheap in the back seasonally. So October, December, and February are cheap, like relative to where they've been over the last 5 years versus the cash index, and vice versa up front, where the front months are a little more expensive relative to where they've been over the last couple of years. So you could see some spread unwinding if we get a wild report on Friday or on Thursday rather, and I think that comes after the close. So we won't even be able to trade that until Tuesday morning or Monday morning rather. So you're talking about Friday, close Friday, Saturday, Sunday, and then reopen. That could be a fireworks show. Maybe making today look a little mild.
Thanks for joining us, John Payne with Hedge Point Global Markets. Let's markets now.